Hello everyone and welcome to my video blog. My name is Nrupin and in this video we will take a look on earnings of a business and earnings per share. So let's start by understanding about earnings of business. For example, let's assume ABC Paints is manufacturer of wall paints. It takes ABC Paints 800 rupees to manufacture one bucket of wall paint. After manufacture, ABC decides to sell per bucket of paint for rupees 400 of profit. So cost per bucket becomes manufacturing cost plus profit plus sales tax. In this case, 800 is manufacturing cost, profit is 400 and 18% is GST, which is our sales tax. So cost per bucket becomes 1416. This is the price for which ABC Paint will sell each bucket of its wall paint. Now if ABC Paints sells 1000 bucket of wall paint, total selling cost will become 1416 into 1000, which is 14,16,000. This is total money that business will receive for selling 1000 buckets. So 14,16,000 is total amount that will flow in business due to total sales. This is also known as gross sales revenue of business. Now though business received 14,16,000 as inflow of money, 18% of it is GST or sales tax. So business has to give this money to government. So 14,16,000 minus 18% GST equals 12 lakh rupees. This is usually the number that appears on income statement of business as net sales revenue or income from operations. Now let's assume to sell each bucket, business has to spend 800 rupees in manufacture and 200 rupees on marketing and sales. So business spent 1000 rupees on each bucket to sell it for 1416. And since business sold 1000 buckets, it spent nearly 10 lakh rupees in effort to generate 12 lakh rupees of sales revenue. The money spent on generating sales revenue is known as cost of revenue or cost of operations, which gives us formula for gross profit. Gross profit equals net sales revenue minus cost of revenue, or gross profit equals income from operations minus cost of operations. In this case, gross profit we get is 2 lakh. This gross profit when simplified is also known as EBITDA or earnings before interest, taxes, depreciation and amortization. EBITDA gives profit business made without excluding general taxes, interest, depreciation and amortization. Now, in spite of the fact that we hear use of EBITDA a lot when it comes to financially measure a business, but as per generally accepted accounting principle, EBITDA is not capable of displaying any kind of financial performance because EBITDA simplifies cost of operations by ignoring expenses that business may incur during functioning of business. But this simplification opens it for heavy misuse. Therefore, as per GAAP, original gross profit is considered as standard for financial measure and not the EBITDA. So keep in mind, whatever you see in EBITDA, it is incapable of showing earning potential of business. Now let's try to break down EBITDA. Interest is amount that business has to pay if it has taken any loans. General taxes are taxes that business need to pay just to keep itself operating. Depreciation is reduction in profit which usually happens due to wear and tear of tangible property of business. And finally, amortization is reduction in profit that happens due to fixed payment schedule if business has any of it. Let's assume in this case business has debt and it have to pay 30,000 in interest. To keep working normally, business has to pay 20,000 of general business taxes. While manufacturing, storage, replacement and delivery, business suffered loss of some of its buckets as result of mishandling or wear and tear. This loss of buckets will add up in depreciation. Let's assume business suffered 25,000 of depreciation. Now suppose business does not have its own storage facility and rents facility for storage. Cost of this storage is 25,000. This cost will add up in amortization because it will happen due to fixed payment schedule of rents. Now if we minus all these from gross profit, we will get profit before tax, also known as PBT. In this case, PBT will be 1 lakh. Now if we negate 35% of corporate tax and 20% levy on it, it will give us important number, which is profit after tax or PAT. PAT is also known as net earnings, net income, net profit or bottom line. In our case, 65,000 is bottom line or earnings of business. If you want to know profit margin of business, divide net profit by net sales revenue. Now this example was given just to explain different terms. So let's see how they really appear on income statement. For live example, we have income statement of Mahindra and Mahindra. Total income from operations and net sales revenue are same. Below it are expenses that were spent to generate above revenue. Everything from consumption of raw material to other expenses can be included in cost of revenue. Here we can see profit before tax, and here net profit we see is profit after removing taxes. This is actual earnings of Mahindra and Mahindra. Keep in mind, net profit, or you can say profit after taxes, always represent actual earning of business. Now to calculate net profit margin, we divide net profit by net sales revenue. The answer we get is 0.089, which is roughly 0.09, or we can say 9%. On key ratios page, we can see net profit margin of 9%. We can see minor difference because on financial statements, most numbers are reduced in multiples of 10 million for simplifying calculation. If we would have used non-simplified numbers, then calculation would have become little lengthier. While talking about earnings of business, we usually hear about everything from gross sales revenue, net sales revenue, gross profit, EBITDA, PBT and net profit. But metric that really is important while considering earning is only net profit. While reading income statement, most analysts prefer to just take a look on net sales revenue and net profit. Other numbers, though are heard a lot, most of the time do not play important role in analysis process. Earnings are also of two types, diluted and undiluted. In majority of cases, the earnings we see on income statement are undiluted, or we can say standalone net profit. Dilution in earnings happen if business under analysis has parent business. When a business share its profits with parent business, earnings get diluted. Diluted earnings are nothing but net profit minus shared profit or diluted profit. We can calculate earnings per share from net profit by dividing it by number of outstanding common shares. Earnings per share is nothing but amount you will receive per share if business decides to distribute all its earning to its shareholders. If business has provided dividends, then formula for EPS changes a little. Now EPS equals profit after tax minus dividends divided by number of outstanding shares. Always keep in mind, when you are looking at net profit and EPS, you are kind of looking at same number. Personally, whenever I have to make choice between EPS and net profit, my preference always goes to net profit. There are 4 different ways you can take a look on business's earnings based on earnings estimate, yearly earnings, quarterly earnings, and successful business model. Then there are also subtypes to these types. For now, the video is getting lengthier, so we will stop here. In next video, we will take a look on them and how they influence business and stock prices.